Stop for a moment and pay very close attention, because what just unfolded in China could have enormous consequences for anyone holding silver, thinking about entering the market, or wondering why this metal has behaved unlike almost anything else in the commodity space this year. Today, something shifted beneath the surface, and almost nobody in Western financial media is discussing it. While headlines focus on price swings and volatility charts, the deeper structural story is being overlooked. And by the time mainstream outlets fully process what is happening in Shanghai, the opportunity connected to it may already have passed. This is not noise. This is not speculation. This is the physical market sending a signal. And if you understand how to interpret that signal, you gain a completely different perspective on what silver may be preparing to do next. Let's start with what most people can see. Silver recently went through one of the most violent periods of volatility we have witnessed in years. In January, the price moved almost vertically, surging more than 60% in a matter of weeks. It was explosive. Momentum traders piled in, headlines turned bullish, and enthusiasm reached extreme levels. Then just as quickly, the market corrected. A sharp sell-off erased a significant portion of those gains. On the surface, this looks like a classic boom followed by a bust. It appears to confirm the common narrative that silver is emotional, speculative, and unstable. That is how many outlets have framed it. They point to excess optimism getting punished and leave the story there. But focusing only on the price chart misses what is happening underneath. While traders argue about technical levels and short-term momentum, the physical supply situation in China has tightened dramatically. And when I say tightened, I do not mean slightly constrained. Warehouses tied to the Shanghai Futures Exchange and those affiliated with the Shanghai Gold Exchange have seen inventories fall to levels not witnessed in more than a decade. Think about that carefully. China is the largest consumer of silver in the world. It drives enormous industrial demand through solar panel manufacturing, electronics production, and advanced technological development. And right now, deliverable silver inside that system is at decade lows. This is not a theoretical projection about something that could happen later. It is happening now. As inventories have dropped, something equally important has developed in the futures market. The front-month contract on the Shanghai Exchange has traded at a record premium. Normally, in a well-supplied and balanced market, contracts that settle further in the future trade at a premium compared to near-term contracts. That condition is known as contango, and it reflects storage costs, insurance, and the time value of money. It is the normal state of a stable commodity market. What we are seeing instead is backwardation. That means near-term contracts are trading at a premium to those further out. In simple terms, buyers are willing to pay more to receive metal immediately rather than later. Backwardation is not just a technical curiosity. It signals urgency. It signals stress. It tells you that participants want the metal now because they are uncertain about future availability. And in China today, backwardation has reached record territory. That is not typical. That is the physical market communicating tightness that paper pricing alone cannot fully reveal. Now consider what this means in combination with another development. Short sellers on the Shanghai Gold Exchange, traders who positioned themselves expecting silver prices to decline, are paying deferral fees to long holders to avoid making physical delivery. Let that sink in. They are paying to postpone delivery obligations. Why would they do that? Because they cannot easily access the metal required to settle those contracts. Instead of delivering, they are compensating long holders for more time. In a comfortably supplied market, this behavior is rare. In a stressed market facing inventory constraints, it becomes understandable. This is what inventory strain looks like in real time. Paper positions expanded beyond what the available physical supply can comfortably support. And when that imbalance surfaces, it reveals itself through backwardation and deferral payments. When this kind of stress appears in the largest silver-consuming nation on the planet, it deserves attention. Now step back and look at the broader context. Despite the dramatic sell-off following the January surge, silver has not collapsed. Instead, it has entered a stabilization phase. Analysts describe the current period as consolidation. After a parabolic rise and sharp correction, markets often require time to reset positioning, digest gains, and form a new base. In silver's case, that emerging base appears to be forming in the $70 to $80 per ounce range. Rather than cascading lower, price action has shown signs of building support within that zone. What makes this especially interesting is investor behavior during the decline. Retail sentiment has remained remarkably steady. There has been no mass panic, no widespread liquidation from silver-related products. In fact, during the initial leg down, buyers stepped in early. They did not wait for a perfect bottom. They began accumulating into weakness. That behavior suggests confidence rather than fear. Year-to-date flows into silver products have remained positive despite the turbulence. Historically, silver often lags gold in the early stages of precious metals rallies. Then, once momentum builds, silver accelerates dramatically. We observed that pattern earlier, Gold began strengthening first. Silver followed later, then surged rapidly to record levels. That volatility cuts both ways, which is why corrections feel intense. But volatility alone does not define the direction of the larger structural trend. The essential question now is whether the recent decline marked the end of the move or merely a pause before another advance. When you combine stabilizing prices, steady retail flows, persistent backwardation in China, depleted inventories, and short sellers paying to delay delivery, the evidence leans toward consolidation rather than collapse. However, consolidation phases can last longer than many participants expect. Sideways markets test patience. They discourage momentum traders and exhaust those seeking quick gains. Analysts from a major ETF provider suggest the coming period may continue to exhibit range-bound behavior as speculative excess is worked off. That is not inherently bearish. It is typical after explosive moves. Markets require time to rebuild structure. The catalyst for the next directional breakout, according to many observers, will likely hinge on Federal Reserve policy expectations. Silver, like other precious metals, reacts strongly to shifts in interest rate outlooks, real yields, and dollar direction. When expectations tilt toward rate cuts, metals often benefit. When the possibility of higher rates lingers, headwinds can develop. Today, uncertainty surrounds that policy path. Markets previously leaned toward anticipating easing, but signals have introduced ambiguity. That uncertainty contributes to consolidation rather than renewed acceleration. Yet even within that tension, positioning data tells a compelling story. Options open interest remains heavily skewed toward calls. Traders continue to position for upside scenarios. They are not abandoning exposure, they are preparing. When you place all of this together, the picture that emerges is not one of exhaustion. It is one of recalibration. Price corrected. Physical supply tightened. Investor confidence held. Structural demand from industrial sectors continues to expand, particularly through solar technology and advanced manufacturing. Supply growth has not kept pace. Deficits draw down inventories, and that is precisely what is visible in Shanghai warehouses today. This is not about hype. It is about understanding the mechanics beneath the volatility. Silver's recent behavior may feel chaotic, but beneath that chaos lies a tightening physical backdrop that cannot be ignored. And if consolidation eventually resolves higher, the groundwork for that move is being quietly laid right now. When you step back and analyze the broader structure, two foundational pillars continue to support the silver market, despite all the volatility and emotional price swings we have witnessed. The first pillar is industrial demand, combined with an ongoing structural supply deficit. Silver is not merely a monetary metal sitting in vaults waiting for investor sentiment to shift. It is a critical industrial input embedded in the global economy. Solar panels require it for photovoltaic conductivity. Electronics depend on it because of its unmatched electrical properties. Medical devices utilize it for its antimicrobial characteristics. Electric vehicles, advanced semiconductors, and modern manufacturing processes all incorporate silver in ways that are difficult to substitute without sacrificing efficiency. This is not optional demand driven by speculation. It is embedded demand tied to infrastructure and technological progress. The global push toward renewable energy alone has created a sustained increase in silver usage that did not exist at this scale a decade ago. Solar installations continue expanding, and each panel contains silver paste that cannot simply be replaced overnight without engineering trade-offs. At the same time, the mining industry has not brought enough new supply online to fully offset rising consumption. Developing new mines is capital-intensive, time-consuming, and often constrained by environmental regulations and geopolitical complications. As a result, the market has experienced recurring deficits where annual consumption outpaces newly mined production. When deficits persist over multiple cycles, inventories become the release valve. And as inventories are drawn down, the cushion protecting the market from supply shocks becomes thinner. That dynamic connects directly to what we are observing in China today. When warehouse stocks fall to decade lows, it signals that deficits are not theoretical abstractions in research reports. They are tangible, they are measurable, and they influence behavior. Industrial users that rely on stable access to silver do not wait until the last bar is gone. They secure supply in advance. That urgency can express itself through higher near-term premiums and backwardation, which is exactly what we are seeing. It is the natural response of a market that recognizes tightness before the broader narrative adjusts. The second pillar supporting the structural case is investment demand driven by macroeconomic uncertainty and evolving currency dynamics. Silver has always served a dual role as both an industrial input and a monetary hedge. When geopolitical tension increases, when confidence in financial systems wavers, when concerns about currency stability intensify, capital historically flows into tangible assets. Gold often receives the initial attention because of its longer established role as a store of value. Silver typically follows with greater volatility once investor conviction strengthens. In periods where trust in central banking policy or sovereign debt sustainability weakens, precious metals regain prominence as alternative stores of wealth. Today, those macro concerns have not disappeared. Questions about fiscal sustainability, sovereign debt burdens, and the direction of global monetary policy remain active topics among institutional investors. Discussions around diversification away from concentrated currency exposure have increased in various regions. These themes contribute to a backdrop in which safe haven demand can resurface quickly when catalysts appear. Silver's sensitivity to these themes amplifies its moves when momentum returns. Even after the significant correction from the January surge, the market has demonstrated resilience. Silver has already regained upward traction, trading above $89 per ounce as I record this analysis. That recovery illustrates how rapidly the metal can reaccelerate when supportive forces align, even if consolidation dominates the broader structure for a period. Volatility does not negate structural strength. Often it disguises it. Now consider positioning data. The options market remains skewed toward call contracts. That imbalance indicates that traders and institutions continue to allocate capital toward upside scenarios rather than hedging aggressively for downside risk. If participants truly believed the larger trend had ended, we would expect a meaningful shift in that positioning. Instead, open interest reflects continued optimism for higher prices once consolidation resolves. This does not guarantee an immediate breakout, but it reinforces the idea that informed money is not abandoning the thesis. At the same time, retail participation has shown composure. During the sharpest phase of the sell-off, there was no widespread capitulation. Buyers entered on weakness rather than retreating. That behavior suggests a maturing investor base that understands silver's volatility profile. Rather than reacting emotionally to each price swing, many participants appear to be treating pullbacks as opportunities within a broader strategy. That stability matters because panic selling can amplify declines and disrupt structural narratives. In its absence, consolidation becomes constructive rather than destructive. Of course, the macro environment still plays a decisive role. Federal Reserve policy expectations remain one of the most influential variables affecting precious metals. Silver responds to shifts in real yields and the trajectory of the United States dollar. When the market anticipates easing conditions and lower rates, metals often strengthen. When tightening expectations dominate, metals can face headwinds. Today, uncertainty defines the outlook. Signals have pointed in multiple directions, creating tension in expectations. That ambiguity contributes to range-bound price behavior as traders wait for clearer guidance. However, even within that uncertainty, the long-term structural reality deserves attention. Elevated debt levels and structural fiscal challenges create pressure on monetary authorities over extended horizons. While short-term policy decisions may fluctuate, the broader trajectory eventually tends toward accommodation rather than sustained tightening. Markets price these expectations gradually, often before official announcements confirm them. If easing becomes more clearly anticipated, silver historically responds swiftly. Another aspect worth examining is the relationship between paper markets and physical supply. A significant portion of silver exposure occurs through exchange-traded funds, futures contracts, and other derivative instruments. These vehicles provide liquidity and accessibility, but they rely on a framework of trust that physical supply exists to back contractual claims. When inventories are ample, that framework functions smoothly. When inventories tighten, stress can surface. The situation unfolding in China, where short sellers pay fees to delay delivery, highlights the tension that arises when paper commitments exceed comfortable physical availability. This distinction does not invalidate financial instruments. It simply underscores the importance of understanding the form of exposure one holds. If the objective is pure price participation, derivatives may suffice. If the objective includes protection against systemic disruptions or counterparty risk, the structure of ownership matters more. In periods of supply strain, the divergence between paper claims and physical availability can become a focal point of market psychology. Imagine a scenario in which consolidation persists for several months. Prices oscillate within a defined range, gradually wearing down speculative excess. Meanwhile, industrial demand continues steadily, and inventories remain pressured. Solar manufacturers do not pause installations because the price chart is flat. Electronics producers do not halt production waiting for lower quotes. Consumption remains active. If no substantial supply increase emerges, each passing month erodes available stock further. Then consider the potential catalyst. It could be a decisive policy shift, an unexpected geopolitical escalation, or a disruption affecting a major producer. When such catalysts emerge, markets that appeared quiet can react abruptly. If that reaction occurs while inventories are already tight, price acceleration can be dramatic. The consolidation phase then reveals itself not as stagnation, but as preparation. None of this guarantees a specific outcome. Markets are complex and influenced by countless variables. Yet the convergence of structural deficits, industrial expansion, steady investment positioning, and physical stress in the largest consuming nation forms a coherent narrative. It is not built on hope. It is built on observable dynamics. As participants navigate this environment, the key is clarity of strategy. Long-term investors often benefit from disciplined accumulation rather than attempting to pinpoint perfect entry levels. Trying to time every fluctuation can introduce emotional errors. Traders, on the other hand, must respect volatility and implement risk management accordingly. Silver can move aggressively in both directions within short time frames. Position sizing and leverage decisions carry amplified consequences in such an environment. Confusion between these approaches frequently leads to losses. A participant who intends to hold long-term may panic during a correction if they subconsciously approach the trade as a short-term speculation. Conversely, a trader who refuses to exit a losing position may rationalize it as a long-term investment to avoid accepting a loss. Clarity about one's strategy before entering a position reduces the likelihood of such mistakes. Ultimately, the present consolidation does not resemble structural decay. It resembles a market absorbing gains while deeper supply tensions quietly intensify. Physical realities do not disappear simply because price pauses. They accumulate. And when alignment between macro catalysts and structural tightness occurs, the resulting move can surprise those who interpreted consolidation as weakness. Understanding these layers allows you to view current price behavior with greater nuance. Rather than reacting to each swing, you evaluate the foundation beneath it. That foundation, at this moment, appears firmer than many headlines suggest. Now let's bring all of this together in a practical way, because information without interpretation does not help you make better decisions. What we are looking at today is not simply a volatile metal that surged and corrected. We are looking at a market that experienced a parabolic expansion, went through a necessary reset, and is now stabilizing while deeper structural forces remain intact. The question is not whether silver can move sharply, because it has already proven that it can. The question is whether the conditions beneath the surface support another leg higher once consolidation completes. One of the most common mistakes investors make during consolidation phases is boredom. When price stops moving aggressively and begins oscillating within a range, attention shifts elsewhere. Momentum fades. Headlines quiet down. It starts to feel as though nothing meaningful is happening. But markets rarely announce their next move loudly during quiet periods. Consolidation is not inactivity. It is preparation. It is the process of digesting prior gains, transferring positions from weak hands to stronger hands, and building the structure necessary for sustained continuation. If you study past silver cycles, you will notice that explosive moves are often preceded by extended stretches of sideways behavior. During those stretches, skepticism builds. Participants question whether the previous rally was temporary. Doubt creeps in. Then, when a catalyst finally emerges, price accelerates rapidly, and those who exited out of frustration scramble to re-enter at higher levels. That psychological pattern repeats because human behavior repeats. Right now, the physical market in China remains one of the clearest signals worth monitoring. If backwardation persists and warehouse inventories remain at decade lows, it reinforces the narrative of genuine tightness. If short sellers continue paying deferral fees to avoid delivery, it confirms that physical supply constraints are not resolving quietly behind the scenes. Paper markets can influence price temporarily, but they cannot manufacture metal. When physical availability tightens, eventually that reality must be reflected. Federal Reserve expectations remain another variable that can shift momentum quickly. While uncertainty currently dominates, clarity in either direction would likely prompt movement. A clearer signal toward easing would support precious metals broadly. Even the anticipation of such a shift can influence positioning before policy changes are formally enacted. Conversely, a surprise tilt toward sustained tightening could create temporary headwinds. However, over longer horizons, structural economic pressures tend to favor accommodation cycles rather than perpetual tightening. That long arc matters more than short-term fluctuations. The options market positioning adds another layer to the picture. As long as open interest remains heavily weighted toward calls, it suggests that institutional participants are not positioning defensively for collapse. They are preparing for potential upside resolution. A dramatic reversal in that skew would merit attention. But as of now, positioning aligns with the idea that consolidation is not synonymous with trend termination. Retail behavior has also remained notably steady. Panic selling has not defined this correction. Buyers stepped in during weakness. Flows into silver-related products have stayed positive on a year-to-date basis despite sharp volatility. That resilience indicates that many participants understand the broader thesis and are not reacting solely to short-term price movements. Now let's address a recurring question many investors wrestle with. Should one buy during consolidation or wait for deeper pullbacks? The honest answer depends entirely on strategy and time horizon. Long-term holders who measure performance in years rather than weeks often benefit from systematic accumulation. Attempting to capture the absolute bottom can result in missed opportunity if the market resumes higher sooner than expected. Dollar-cost averaging reduces the emotional burden of precision timing and allows participation across multiple price levels. Traders operating on shorter time frames must approach silver differently. Volatility requires discipline. Position sizing must account for potential rapid swings. Leverage, if used at all, must be controlled carefully. Silver's ability to move $10 within days is not theoretical. It has happened. Without clear risk management, even a correct long-term thesis can translate into short-term losses that damage capital and confidence. Confusing these approaches creates risk. Entering with a trader's mindset and then refusing to exit when price moves against you can morph a trade into an unintended long-term hold. Beginning with a long-term thesis but panicking during corrections transforms investment into emotional reaction. Clarity before entry matters more than conviction after volatility begins. Another consideration is the distinction between paper exposure and physical ownership. Exchange-traded funds and futures contracts provide efficient access to price movement. They offer liquidity and convenience. However, they operate within a framework that assumes underlying supply integrity. In stable conditions, that framework functions smoothly. In periods of tight supply, stress can surface. The developments in China, where short sellers are compensating counterparties to delay delivery, illustrate how paper obligations can collide with physical constraints. This does not invalidate financial instruments. It simply underscores the importance of understanding what kind of protection or exposure one seeks. If the objective is speculative price participation, derivatives may serve that purpose. If the objective includes hedging against systemic disruption or currency instability, the form of ownership becomes more relevant. Imagine the next phase unfolding quietly. Consolidation continues, volatility gradually compresses, attention shifts elsewhere. Meanwhile, industrial demand remains steady. Solar expansion does not pause. Electronics production does not slow. Inventories, already strained, remain under pressure. Then a catalyst emerges. It could be policy clarity. It could be geopolitical escalation. It could be an unexpected supply interruption. Whatever form it takes, the dormant energy built during consolidation releases quickly. When markets reprice in the presence of tight supply, movement can be abrupt. That scenario is not guaranteed. Markets are dynamic and unpredictable, but the structural components supporting it are visible. Depleted inventories in the largest consuming nation, record backwardation signaling urgency for immediate delivery, short sellers paying fees rather than delivering metal, stabilizing prices after correction, persistent call skew in options markets, steady retail participation, strong industrial demand combined with supply deficits. These are not isolated data points. They form a coherent framework. The key takeaway is not blind optimism. It is awareness. Awareness that consolidation does not equate to weakness. Awareness that physical supply dynamics can diverge from paper narratives. Awareness that volatility can obscure strength as easily as it can expose fragility. If you are watching this unfold, the most valuable action may not be immediate trading, but disciplined observation. Monitor warehouse levels in China. Watch for changes in backwardation. Observe shifts in options positioning. Pay attention to Federal Reserve communication. Evaluate whether retail sentiment remains steady or begins to fracture. These signals collectively provide a roadmap. Markets reward preparation more often than prediction. By the time headlines proclaim a breakout, much of the move is already underway. Those who positioned during quieter periods often benefit most. Those who dismissed consolidation as irrelevance often find themselves reacting rather than anticipating. Today, silver stands at an inflection point defined not by dramatic headlines but by subtle structural signals. The volatility of January captured attention. The correction tested conviction. The consolidation now tests patience. Beneath it all, physical tightness in China sends a message that should not be ignored. Whether the next leg higher unfolds soon or after further range-bound movement, the framework remains consistent. Industrial demand continues expanding. Supply growth remains constrained. Inventories are pressured. Investment positioning has not collapsed. Policy expectations remain a catalyst waiting for clarity. The pieces are in place. Timing remains uncertain. Structure remains supportive. As you navigate this environment, remember that markets often move when conviction quietly rebuilds rather than when excitement peaks. Consolidation is where that rebuilding occurs. Patience is rarely glamorous, but it is frequently rewarded. Keep your focus on the signals that matter. Watch China's warehouses. Watch backwardation. Watch policy expectations. Observe positioning. The real story is unfolding beneath the surface. and those willing to look beyond daily price swings may see it more clearly than those chasing noise. Silver's recent volatility was dramatic. Its next chapter may be even more significant.